We don't rely on gold anymore. So what happens is our currency leaves the country, and then those foreign entities can reinvest that into our assets. So, for example, if we run a very big trade deficit with China, they can buy treasuries, for example. That was a classic use case. Increasingly, they've been deciding to buy equities or real estate or private equity and things like that instead. And so basically what we're doing is we're selling part of our appreciating capital stock, our ownership in businesses, our ownership in real estate, our income producing long lived assets. We're selling ownership of that in exchange for current depreciating goods. And so the amount of American assets that the foreign sector owns relative to the amount of foreign assets that American owns is now very lopsided. So back in the 70s, for example, the United States as a whole, whether it's government entities or whether it's, mostly it's private Americans, we owned more foreign assets than foreigners owned American assets. But because of accumulated trade deficits, now it's the opposite. Now the rest of the world owns way more American assets than we own foreign assets, to the tune of something like negative 70% of GDP, which is, one of the most, it's the most negative out of any large country, and it's the most negative in absolute terms, one of the most negative in percent terms. And that's the thing that starts to become just eventually structurally impossible to keep going. It's hard to say exactly where that stopping point is, but it's not like negative 300% of GDP. It's like maybe negative 100% of GDP is where you start to kind of run into that there's just not enough fuel to keep that engine going. We already started to see shifts ever since the global financial crisis. So for decades, foreign central banks were holding less and less gold and more treasuries. That started to reverse. So ever since 2009, they've been increasing their gold tonnage, and ever since about 2013 or so, their foreign central bank exposure to treasuries has kind of flatlined. So they're not like rapidly selling their treasuries, but they're not really accumulating them at the rate they used to. And so overall, it's just this gradual shift. Kind of what led that was China decided it was more in their interest to do the Belt and Road Initiative type of investments. They want to take their surpluses and then go out and fund commodity deposits or fund port infrastructure and things like that, rather than just keep buying more and more treasuries or U.S. stocks and things like that. And so over time, that kind of, in some ways, multipolarizes the world. Then we've seen a couple kind of watershed moments, like Russia invades Ukraine. American, European entities freeze Russian reserves, and then that forces them to redenominate some of their contracts elsewhere, accelerate their building of non-dollar payment systems. Other countries see that and say, well, I want to reduce the tail risk that ever happens to me. And so they start making bilateral trade agreements. And this is, again, it's a very large network effect, but it's one of those things that quarter after quarter, year after year, it's starting to take shape. And we're seeing in general the percentage of dollar-based assets in foreign reserves is very slowly kind of diminishing. The peak was around the year 2000. First, the euro disrupted it a little bit, but lately, some of the Asian currencies, particularly China, has been taking market share, while Europe has been giving up market share. The United States is kind of flatlined, or ever so slowly kind of inching down. So I think that partially technology and partially geopolitical incentives and partially imbalances, you're just getting a kind of a gradual acceleration of all these kind of non-dollar payment systems, or the desire to hold alternative assets that are less kind of heavily invested in the U.S. And that disrupts us at first, but I think in the long run that helps us rebalance things. And I think that reshoring is one of those long-term goals, but it's going to be very, very hard while you still have this current system in place. Because as long as there's so much global demand for dollars, trade deficits are how those dollars get out there primarily. And if you're running a structural trade deficit, then pretty much by definition, you're not reshoring as much as you'd probably like to. And if anything, what's reduced our trade deficit to some extent is our oil production. So we're less reliant on imports than we used to be, but our ability to physically make, machinery and industrial type of things is still kind of heavily impaired. We've seen, for example, Taiwan Semiconductor wanted to, they're in the process of building U.S. facilities, which is a good thing. But then they found, okay, we have a shortage of labor, like the right kind of skilled labor that is required to make these, various advanced equipment, we have trouble finding the people to do that because in addition to all the physical capital, there's just a deficiency in human capital because that's not what we've emphasized for decades. If you wanted to get wealthy, you'd go work in Wall Street. You wouldn't go work in kind of blue collar manufacturing or kind of having the best technicians in the world. We have really good technicians, but not to the same scale that you see in China, Taiwan, and kind of many other countries in the world. They've kind of built up that culture of manufacturing and physical production, and that takes years and potentially decades to gradually realign back to kind of national interests. We've had over 4 decades of structurally declining interest rates until they hit zero, they hit negative in some cases. When you have ever rising debt to GDP, there was a lot of alarmism about that back in the 80s and 90s. But what they didn't anticipate is you would have decades of declining interest rates. If you double your debt, but you have your interest rate, then your interest payments remain the same, especially relative to your growing income. And so, that's been a kind of a balanced force for a while. The problem is when debt as a percentage of GDP is still rising, but interest rates hit zero, bounce off zero, and start going even just sideways in kind of this more moderate band, then those fiscal deficits start to kind of get out of control. In addition, there is a valuation bubble in some of those spaces. So back in 2019, I wrote about the bond bubble, kind of emphasized it again in 2020 and 2021 as kind of the early stage of this kind of fiscal injection started to play out. And the issue there is that when bond yields get super cheap, it basically means that bond prices are very overvalued. Bond proxies, like for example, utility stocks or defensive consumer staple stocks, they get very expensive. And then the other area that's really impacted is VC, or broadly any sort of unprofitable tech, including publicly traded ones, because they've been in an environment where interest rates are so low, so the opportunity cost for usage of capital is low. And so people are very willing to monetize equities. They're saying, well, I'm getting zero return on my cash anyway. I might as well hold this long duration tech play, even if it's got no clear sight to profitability anytime in the near term, because my opportunity cost is zero and getting devalued. So they bid very high valuations, and what that does is that these companies can then issue a ton of equity to kind of cover their losses and keep operating their business. They can underprice their goods and services and therefore emphasize growth at all costs. And the problem is that if it returns to that there's a cost of capital, that if you can earn 3, 4, 5% by holding fairly safe money or money-like assets, the valuations you pay for these companies is lower, which impairs their ability to cover costs by just more and more equity issuance, which then means they have to try to raise prices and get a little bit more towards equilibrium, which then slows down their growth a little bit, which then has a feedback loop of making the equity valuation even lower until it kind of right sizes to the point where it actually finds out, okay, what is the actual total addressable market of this company if the prices are not artificially low because of the expectation of just endless equity issuance. And so basically it's just that the magnitudes all get tweaked back in that kind of bond bubble that existed. And it's painful to go through a period to say, okay, how can we separate the wheat from the chaff here? So what kind of companies only existed because interest rates were zero versus which ones are still very valuable, but that might just have to be right sized a little bit in terms of valuation or growth expectations because they have to align a little bit more towards profitability and a little bit less towards just ever constant equity dilution because of exceptionally high equity valuations. So that's kind of the one of the more disrupted areas, and it just changes the magnitudes of a lot of these things. And it's important, I think, going forward that I think we're probably in a more sideways choppy band for interest rates. There probably is a cost of capital going forward, and that makes it so that when you model out what you can pay for an idea, it just changed the equation to some extent and adds a little bit more conservatism back into that because it's not an environment where there's zero opportunity cost anymore.